we know what you want. You want to invest in the stock market while minimizing the risks to your money. Well, you're at the right place. Hello and welcome back to Tide to Wealth, where you're just one sale away from financial success. In today's video, we're going to talk about the summary of one of the best investment books out there, The Intelligent Investor. The author, Benjamin Graham, has created a simple guide to investing for beginners. The book focuses on long-term, risk-adverse approaches. According to Graham, you should be focusing your investments on research instead of speculation. In other words, he teaches you how to get involved in value investing. You know who else believes in value investing and practices it religiously? Warren Buffett. Yep, this book changed his life.
It's really a pleasure for me to be able to talk to you about Ben Graham. I've had some lucky days in my life, but one of the luckiest was in 1949 when I was 19 years old in Lincoln, Nebraska, and I picked up a copy of The Intelligent Investor. It not only changed my investment philosophy, it really changed my whole life. I'd be a different person in a different place if I hadn't have...
So, let's dive right into Warren Buffett's favourite book of all time and all the lessons it teaches. Lesson 1. Understanding the history of the stock market and market fluctuations. It's quite clear that the stock market is subject to various cycles of boom and bust, and it's extremely important to understand these cycles, because people usually try to make money from these short-term fluctuations, and most of these people end up losing. These are the mistakes that are made by these investors. Buying into the hype of strong bull markets, not doing their own research, relying on experts who are not necessarily experts, not staying humble when their stocks are performing well. Those who do not remember the past are condemned to repeat it. Lesson 2. Be mindful of inflation. Everyone talks about how death and taxes are inevitable, but what no one talks about is how inflation is inevitable too. There might be short periods of deflation, but the general trend is that your money becomes less valuable over time. $1 10 years ago was worth way more than $1 today. That's why you must invest instead of holding cash. A lot of investors don't really consider inflation when they're investing. This is what psychologists call the money illusion. You see, a 2% raise in yearly salary is technically a pay cut, since inflation in the United States for 2022 was 8%. But even then, if you ask people, they'd rather take a 2% rise in an environment where there's 8% inflation than take a 1% pay cut during a year when inflation has been zero. Assess your long-term investment success by evaluating your returns after accounting for inflation, rather than solely focusing on your investment gains. Lesson 3. Stocks can't reliably overcome inflation. Yep, stocks can't exactly reliably overcome inflation. You see, stocks typically outperform inflation 80% of the time. However, it's important to note that many stocks don't perform well during periods of high inflation. For instance, in 8 out of 14 years when inflation exceeded 6%, the stock market experienced losses. Mild inflation can benefit stock prices because it enables companies to increase their prices. On the other hand, when inflation is significantly high, it can lead to decreased consumer spending, which can negatively impact stocks. Therefore, investing in stocks is generally advisable when inflation is at a manageable level. Being aware of inflation is crucial for effective risk management in investment strategies. Lesson 4. REITs can overcome inflation. So what should you do to overcome inflation? Well, look into REITs. A reliable investment opportunity in the face of inflation is real estate investment trusts, REITs. These are companies that own and lease out various types of properties, ranging from medical facilities to commercial spaces. Despite targeting just one industry, REITs tend to be effective in hedging against inflation. Investing in REITs provides you with exposure to the real estate market without the need to own physical properties. You know what this means. You don't have to worry about maintenance, repairs, or even finding tenants. Moreover, REITs commonly distribute a solid proportion of their earnings as dividends to shareholders, making them an appealing choice for investors seeking consistent income. Lesson 5. Don't let age influence your investing. Don't think about your age when you're investing. Instead, think about these aspects as they're more important. Do you have a partner? And if so, are they employed? What is their income level? Do you have children? If not, do you want children? How much will that cost you? Will you inherit money at some point? Do you have a solid job? What is the typical lifespan of a similar business if you work for yourself? Do you need your investments to supplement your cash income for you to survive? If you do, then you should have more money in bonds. How much money can you afford to lose on investments? Lesson 6. Adopt an evidence-based approach to investing. The intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. The intelligent investor dreads a bull market since it makes stock more costly to buy, and conversely, you should welcome a bear market since it puts stock back on sale. There are two ways to become an investor. Firstly, you can be a defensive investor. A defensive investor is someone invested in safety and freedom from effort. If you want to become a defensive investor, you need to learn how to deal with your emotions. For example, you need to be able to detach yourself from market panic. Secondly, you can be an enterprising investor. An enterprising investor dedicates a significant amount of both their time and intellectual energy to their investment endeavours, requiring substantial commitment on both fronts. Both investors should stay away from speculation, and they need to focus on the actual finances of the company, its balance sheet, and how it has done historically. Lesson 7. How to be a defensive investor. The defensive investor must confine himself to the shares of important companies, with a long record of profitable operations and in strong financial condition. When choosing stocks as a defensive investor, assess the following factors about each company. How large is the business? Choose larger and less volatile companies such as Coca-Cola. Assets should be at least twice as much as liabilities, and long-term debt should be less than net current assets. Positive earnings should be recorded for the past 10 years. Dividends should have been paid out without interruption for the past 20 years. The per-share earnings should demonstrate a minimum increase of at least 1/3 compared to the past decade. The price-to-earnings PE ratio should not exceed 15 times the average earnings for the previous 3 years. The price-to-assets ratio should remain below 1.5 times the last reported book value. Additionally, the product of the PE ratio and the price-to-book PB ratio should not exceed 22.5. Lesson 8. Learn how to be an enterprising investor. Graham recommends these key considerations for enterprising investors looking into companies. The company's current assets should be at least 1.5 times the current liabilities. Neither should their debt increase more than 110% of net current assets. There should be no earning deficits in the last 5 years. There should be a dividend. Last year's earnings should have been more than those of the year before. The price of the stock should be less than 120% of net tangible assets. Lesson 9. Learn how to invest in stocks. Here are key tips for investing in stocks found in the book. Don't day trade, not worth the risk. Initial public offerings, known as IPOs, are overpriced and not a good investment. Avoid cheap bonds like the plague. Only buy foreign bonds if you are incredibly confident. A great company is not an excellent investment if the stock is overpriced. Big firms grow slower, so avoid companies with price-to-earnings ratio over 25 to 30. Look out for temporary unpopularity. The market quickly forgets, and this stock will probably rebound if you get it at a discount price. Lesson 10. You can make lots of money from market volatility. Market volatility can invoke fear, Yet, it also presents opportunities for substantial gains. To safeguard against losses during these volatile times, it's important to base investment choices on evidence. In other words, please avoid panic selling because you'll only lose. Because the interesting thing is, there exists a paradox where highly successful companies tend to experience more fluctuations in their stock prices. This suggests that it can be advantageous to consider purchasing shares of these larger companies when they are selling at a discount. Lesson 11. Be careful about using financial advisors. Financial advisors may not be suitable for everyone, as they often require a minimum investment of $100,000. Individuals with limited funds may find low-cost index funds to be a better option. For those with the right resources, the decisions to work with a financial advisor depends on individual preferences. Many investors would want to get a second opinion when making decisions, especially those who struggle to determine the required rate of return. Here are some signs that indicate you may benefit from professional investment help. You suffered significant portfolio losses exceeding 40%. You're facing financial difficulties. Your portfolio lacks organisation and a clear strategy. You're undergoing major life changes like retirement or self-employment. It's important to be cautious of fake advisors who may lead to financial losses. They often use persuasive phrases such as opportunity of a lifetime and become rich like me and downplay their fees. Investors should be skeptical of such claims. Oh, and if you're enjoying this video so far, would really appreciate it if you like and subscribe. Lesson 12. Conduct security analysis. Conducting security analysis is essential to calculate the value of a particular stock. This evaluation allows you to compare the estimated value with the stock's current price to determine its attractiveness as an investment. To avoid overpaying for a stock, consider the following factors: the company's long-term growth prospects, the competence and effectiveness of the company's management, the financial stability and capital structure of the company's track record of paying dividends, the current dividend yield. For bonds, it's crucial to assess the number of consecutive years in which available earnings have covered total interest payments. This coverage should extend for at least 7 consecutive years to ensure the bond's reliability. Last but not least, Lesson 13. Keep within the margin of safety. Believe me when I tell you folks, having a margin of safety is crucial. This means that you should buy the company's stock at 50% below the value. This practice serves to minimise potential losses and maximise profit opportunities. For example, suppose you've conducted thorough research on a company called TechCorp and determined its true value to be $100 per share. However, the current market price for TechCorp stock stands at $70 per share. According to the margin of safety strategy, you would refrain from buying the stock at this price. Instead, you would patiently wait for the price to drop to $50 per share or lower. This 50% discount from the stock's true value acts as a protective cushion, guarding against overly optimistic valuations or unexpected negative developments. If the stock price rises, you can potentially realise substantial profits. And even if the stock price declines, your potential losses are significantly reduced compared to purchasing the stock at a higher price. So, there you have it folks. Let us know in the comments if you think this book has what it takes to make you an awesome investor. See you next time.